Welcome to the Daily Update, where I'll go over the action in the market for Friday, April 14th, and then we'll see how things look for Monday, April 17th. We had a bit of a down day. That's the negative side. However, we did close up off the lows. Our charts are still staying positive for the most part, and it looks right now that we're just working off this overbought condition as we went up a little too far too fast. We'll be looking at things each day to see if they shift from being positive back over to negative. But for right now, everything still remains positive. Before I get started on the video, please note from April 22nd through the 14th, I will be traveling. I'm going to do my best to post the daily videos and the other videos if I can. Also, I do have a podcast that you're welcome to check out. It's just a carbon copy of what you're watching right now. Both in the videos and in the podcast, there is a PDF that shows all of the slides and charts so you can follow along. I do have a private Facebook group that you're welcome to join. The poll is posted. I'll be going over that in the weekly video, and then I'll be posting a new one for the upcoming week and weeks. All right, let's go back and talk about what happened. At the open, we had a higher open. Prices almost got up to R1 at 41.83, not quite that level. Before they fell back down to the unchanged level, we kept going below that, and then down through the daily pivot at 41.32. As the day went on, we kept falling. We fell down to S1 at 41.14. That was the support level that we found. We bounced up off of that once and then twice before climbing back and then closing above the daily pivot. We were down 0.21% on below average volume. That seems to be the story that's happening. The technicals, as I said, are still positive overall, working off some of this overbought condition. We do have some overhead resistance if prices keep going up. There's other things in the other indexes, specifically the NASDAQ and NASDAQ 100 that we're watching right now. The small caps still are lagging behind, and we just keep watching those things every day. Inflation and interest rates are the name of the game, and now we're starting to come into earnings season, and that will have an impact on the market. Also, sitting in the background is wondering if we're going to get any more banking information. Here's the intraday chart showing how we did open higher. We went almost up to R1 before falling back through the unchanged level. We came down to the daily pivot, tried to set up some base here. That wasn't happening. We fell down below that, came all the way down to S1, bounced up off of that, bounced up off of S1 again. Came back above the daily pivot, saw some weakness, but then we saw some strength going into the close. Large cap growth and value also followed pretty much the same route. In Friday's session, growth was down more than value with the large caps. It was down less with the mid caps and a little bit less in the small caps. Here's the intraday chart. We were drifting lower in the overnight session. That also fed into the pre-market session before we saw things improve quite a bit, went positive, even spiked up. That was the high that we set right after the open, spent a lot of the day falling, and then during the latter part of the day, we recovered from that, and then the SPY will resume trading on Sunday afternoon. What are some comments that we can make? JP Morgan, Citigroup, BlackRock, and PNC Financials all came out with their earnings reports. They were taken as positive. This ended up pushing the financial sector up over 1%. Then Fed Governor Waller came out, who is an FOMC voter, and he said that the Fed hasn't made much progress in its inflation goal and that he thinks monetary policy needs to be tightened further and remain tight longer. That's what the market picked up on and didn't really like what he was saying, but it's what the Fed has pretty much been saying all along. It's the market that's creating these rosy scenarios that seem to get dashed. Volume continues to be below average. On a short-term basis, we have the stochastics and the Stoch RSI, as well as the Williams percent R that are extreme positive. Intermediate term, we're watching that TTM squeeze, as well as the PMO study, and the Sean trend meter has ticked back up. The dollar was up, and interest rates were also up. The home builders ETF negative divergence that we had been seeing, that seems to be going behind us now, and they're getting back to the point where the S&P and the home builders are in a really strong correlated relationship. The 30 to the 5 is not inverted where all of our other yield curves are inverted. Sentiment is positive at 67. It ticked up even though we had a down day. It had been at 65. Our trend is positive, but the green line is going down. However, when you compare it to the moving average, it's going up, but it's still below 20. I've switched our bias back to mixed because even though it was a down day, we had a strong up day on Thursday, and I've kept our momentum at mixed. The economic reports that came out, we had total retail sales, which came in down 1%. They expected it to come in down 0.4%. Last time it was down 0.2%. If you take out autos, we were down 0.8% month over month. They expected it to be down 0.4%. Last time it was unchanged. Import prices were down 0.6% month over month, and that equates to a minus 4.6% year over year. If you take out fuel, import prices were down 0.5%, and on a yearly basis, that equals being down 1.5%. Export prices were down 0.3%. On a year basis, that's down 4.8%. If you take out agricultural products, we're down 0.2%. On a yearly basis, that's down 5.2%. Total industrial production came in up 0.4%. They expected it to come in up 0.2%. Last time it was up 0.2%. Capacity utilization, we're falling below 80, so that's showing a bit of a contraction, but it came in stronger than expected at 79.8, where they expected it to be at 79. Last time we had this report, it was at 79.6. Business inventories increased 0.2%. They expected it to be up 0.3%. Last time it was up 0.1%. Consumer sentiment came out with their preliminary reading at 63.5. They expected it to be at 62.7, so that was better than expected. Last time it came out at 62. A year ago, it was at 65.2. Then this is the part that is taken as being more negative. We're looking ahead. The inflation expectations rose to 4.6%, where it had been at 3.6%. Looking at some IsabelNet charts, this first chart just shows that we're still pretty high with the yield curves that are inverted, and that is suggesting that we may head into a recession. Looking at this forecast, this is put out by Goldman Sachs. They think that we'll have a 35% chance of going into a recession, where the median, it's a 65% chance of going into a recession. This chart is historical, and it just shows there's 16 recessionary bear markets over the last 150 years. This chart says that there's the largest outflow from tech on record. People are taking a lot of money out of tech, which is strange because tech has been really leading the market higher recently. We might see this figure change, and this could produce a positive backdrop for the tech sector. Looking at housing, the MBA Purchase Index continuing to show a little bit of improvement. That's this dark blue line here, and then we can also compare that to other years. The latest reading of the active asset managers came in at 58.71. Now this is a week old, so it might bump up after having an up week. And with this reading, we're not really extreme. When you look at credit default swaps, they're really high. That's the dark blue line here. And if things start to go kind of wacko in the economy, or if interest rates keep getting raised, is this going to present some kind of a problem? We did have a problem with this back in 2008, going into 2009. We also had another problem back in 2011, and then another one at the beginning of 2014, with this really spiking up and then coming back down. If this starts to come down, will that really boost the VIX up? And usually the VIX rises when stocks are falling. Looking at the earnings per share cuts, that's the red line over here where they're really dropping down. And then other times when similar readings were happening, that marked pretty negative times in the market. Looking at the Real Investment Advice blog, actually this is their weekly newsletter. The headline says, recession odds jump as the Fed crushes consumers. What they're pretty much saying in this post is that a recession could be good economically. Now, it sucks for people and it sucks for businesses and it's not good for politicians, but it produces a reset or a cleansing of the economy. If the Fed or the government jumps in to try to make it not as bad as it could be, that just prolongs the pain and makes it even bigger somewhere down the road. That's my conclusion. What they're saying here, they're wrestling with this idea that, okay, maybe a recession would be a good thing so the market could reset itself. But at the same time, the Fed is working between a rock and a hard place. The rock is that they're trying to fight inflation, so they're raising interest rates. The hard place is if they raise interest rates too much, that's really going to hurt the banks and hurt the economy, and so it's kind of a no-win situation. And an economy as big as the U.S. economy, it's really hard to have that Goldilocks approach. Here's a chart showing that why we can't raise rates that much. This light blue line is interest service on debt. It's really going up and much higher than we've seen in a long time. This chart just suggests that the Fed always breaks something. Either they're going to raise rates too much and that's going to hurt the economy, or they're not going to raise rates enough and that's going to produce inflation. And we see that the Fed funds are going up, credit cards are going up, loans are going up, and that puts a real burden on the economy. This chart looks at how were we a while back in our history when we had a net worth where there was virtually no leverage used to create that. When this shaded area crosses above the black line, that means that debt is now starting to outsurpass not being leveraged. And that happened just about in the dot-com bubble, right in about 2001, where now debt is far outweighing the creation of assets. And will this pose some kind of a problem longer term? After 9/11, the government and the Fed really stepped in to help the markets, and it's pretty much been that way ever since. Is this blowing up this balloon so big that at some point it's going to pop? Another thing that's really weighing on things is the annual change in money supply. They flooded the market and the economy with all kinds of dollars when they did the COVID bailouts. Well, now they're starting to reel that back in, and will that have a negative impact on the economy? Because there's less dollars out there. Yeah, that takes away the inflationary pressures, but is that going to hurt the growth that needs to take place to keep the economy going in the right direction? Then looking at a chart that I have, this is consumer sentiment, how it ticked up slightly to 63.5. It's still very far away from the 2-year yield, so we're seeing the spread pretty far in this chart down below. Then looking at our analysis, we still have the Ulcer Index giving us a very low reading, which means there's not a lot of fear or there's a lot of complacency right now. Here's the VIX, how it continues to fall. It's getting lower and lower. And this is like a spring or a coil or a jack-in-the-box. So you keep winding it up, and the more you wind it up, the greater it's going to jump out when it finally releases. Is that what's happening here with the VIX? We're seeing volatility really falling on the line chart as well as on the bar chart. And to see this go down on a down day is strange. And so I'm keeping an eye on the other chart. It's not showing us anything yet, but we'll keep watching that. Here's volatility showing how it's ticking down slightly. The equity put call ratio hasn't really changed all that much. It has been providing some support to stocks. When this was giving us a high reading, that means that people were going in and hedging, thinking the market was going to go lower. Well, when you get too extreme, that often marks a bottom in the market and gives some support to the S&P, and that's what we've been seeing so far. Can this continue? The fear gauge continues to fall down overall based on this chart, and we're seeing fear starting to decrease on this other chart that we use. The high beta stocks against the S&P 500 ratio still shows that folks are tending to go more in a risk-off type of posture. Here's the condition of our trend showing the green line going down, so it's positive but declining. The ADX is above the moving average and advancing, but we're still below 20 overall. Another thing that you could take as positive is the red line is also declining. The Arun continues to show improvement. We're above zero and advancing with the oscillator, showing that buyers are in control and sellers are decreasing. Here's the look at the daily chart. It's interesting. Even though we closed down, we're starting to make a couple of higher highs in here. So it makes this chart look a little better than it really is right now. We have to see follow through with price. But as I've been saying, if we get up to this level, we might have this resistance level and this upward sloping trend line converge on each other, and that could produce some pretty significant overhead resistance. On the bottom, you see where volume is really dropping off. The slope is pretty much still on top of its moving average. It's the only one of our oscillators that is even suggesting that things are turning negative. All the other ones are positive. The PPO study, long term, we're still above zero. Intermediate term above zero. Short term, we're flat, but we're still above zero, so that's positive. The Stochk RSI is still extreme positive, even though it declined a little bit, as well as the Williams percent R. The short-term stochastics still extreme positive, but they are dropping. We're still extreme in the intermediate term as well as the long term. The force index came down just a little bit, but it's still above zero. That's positive. We're above all plotted moving averages. The parabolic SAR is positive. The swollen trading oscillator ticked down just a little bit based on price and volume, but it's still above zero with both, so that is positive. The vortex shows the green line continuing to go up and the red line continuing to go down, so this chart is positive. Here's the Sean trend meter just on the verge of being extreme positive. The Chaikin oscillator continues to decline, keeping an eye on that. RSI 14, still above 50, even though it declined, and we never got to an extreme positive reading with the RSI 9. This is another warning sign that I've been pointing out. The S&P continues to underperform utilities. We want to see this really going up, and it's actually going down. The PMO study, we're coming off of an extreme reading with the PMOs that are rising. We're still extreme and flat with the buy signals and showing some improvement with the PMOs that are above zero. The BPI continues to show some internal strength. It continues to climb. And the NYSE bullish percent index is just a little bit below 50, but advancing. The Chaikin money flow starting to fall off just a little bit. Could be a potential warning sign. The balance of power ticking down, but still above the dashed line. That's positive. We're watching these bars here. They're turning darker blue, which means they're still positive, but not as positive as they were when they were lighter blue. The go-no-go system is still positive with the blue bars. We're still above this anchored moving average going back to the all-time high, and these other 50-period moving averages are starting to come above that moving average. That could be more positive. Here's another look at the anchored moving average going back to the all-time high, and if we start to fall, we'll be watching this level at 4,074. The fib levels were above this 41.23 level. If we start to fall, will this end up providing support? Our longer term fib chart, we still have some resistance above current price at 41.56. And long term, if we fall, we have support at 40.20. If we continue to go up, we're looking at the 4,214 level. We also have overhead resistance in our quadrant chart above current price, just under the 4,200 level. The equal weight index continues to underperform the S&P 500, a little bit of a warning sign. We're also seeing that in this chart, where the big stocks are outperforming the smaller stocks. The Elder Impulse system for the S&P has switched back to neutral. The McClellan oscillator, after being extreme positive, has fallen down, but it's still positive overall. And the NYSE McClellan oscillator still above zero, even though it is declining, so it's positive. The summation index based on price and volume continue to advance. Looking at the new take on Dow theory, we're breaking above this blue line with the S&P where it's acting as resistance in the NASDAQ. That could be a negative divergence. And here we're also seeing in traditional Dow theory where the Dow has been doing a lot better, but the transports have not. Utilities were doing better, but are now starting to turn back down. And this chart also shows how the transports are underperforming the Dow. This is another warning sign. We're not seeing a breakout in new highs. Even with that thrust higher right at the open, there were not a lot of new highs that were registered. So this could suggest that internally weakness may be starting to develop. Our 5 period is rolling over and our 10 period is starting to go flat. The advanced decline line, we're still seeing this negative divergence between price and volume. But the NYSE advanced decline line is still looking pretty healthy overall. The advanced decline ratio, even though it declined, is still above zero with both the red and blue lines. Accumulation distribution continues to be positive. Volume continues to drop off. The money flow index continues to be positive. The ultimate oscillator is also positive. On balance volume, even though it declined, is still above an advancing moving average. The financials had a little bit of a recuperation with the banks reporting their earnings, so that showed some improvement with the financials. But when we compare the regional ETF, it continues to show weakness compared to the financial sector. Looking at our broad range advanced decline line, the NYSE ticked down but is still above the moving average. The same thing with the S&P, mid caps. The small caps are lagging behind. The Dow, after hitting this R1 resistance, has now backed down, but it's still above its 50 and 200 period moving averages. The diamonds have switched to neutral. Here's the NASDAQ looking at this double top, wondering if we can break through this area. And if we do break through that, then we have a previous high that we're also keeping a close eye on. And the NASDAQ 100 also, can it break out against this shorter term top and get through this upper resistance? The Qs have switched to neutral. We're still above this 38.2% retracement. If we fall, that may provide support. If we go up, we have a long ways to go to hit the next resistance level. This is a chart that I've been showing all week. We came up to the all-time high with the QQQs, which is the NASDAQ 100, and we've been having a really difficult time being able to break through that level. The micro caps were down but have not set a new 52-week low. The small caps continue to remain under the 200-day moving average. The Russell is still somewhat positive with the RSI, even though it declined. It's above 50, where the MACD continues to advance. And the small caps have now switched back to being negative, and the small cap ratio continues to really underperform the S&P, and we're seeing a death cross in this ratio. The mid caps are still above their 200-day moving average, but having a difficult time breaking through this pivot level. And the mid caps have switched back to neutral. Here's the home builders. You can see at the bottom, the relationship is really strong, almost a 1-to-1 relationship. It looks for right now that this divergence could have been a positive divergence, but it goes against what I've seen on this chart previously. The Copic curve remains on a buy signal, but it is starting to roll over. And the Pring bottom fissure is starting to get to an extreme reading, rolling over, but is still positive, giving us a buy signal. Bond yields were up in Friday's session, and bond prices were down. We're seeing a crossover with the MACD, with the 10-year. The RSI is still above 50, but it is declining. Our long-term trend is still intact. This is a full week now, so we're above 0 with the MACD. So for right now, this downward sloping trend line that we see here and the breakout that happened above that still appears to be legitimate. An update of our possible positive scenarios. The 10-day average of the S&P highs minus the lows. We're still getting a pretty positive reading overall, even though it did drop. So you can take that as positive, and we can stay up in this area for a long time. You could also take this as negative, saying that we might have shot up too far too fast. We're also working off the latest signal from the ZWAG NYSE breadth thrust. And here's a look at the returns from 1, 3, 6, and 12 months out when a ZWAG breadth thrust has been triggered. This is another concern. When we look at the Amex, NASDAQ, and NYSE, we're still below 0 with the 5-period moving average of the highs minus the lows. Looking at our ratios, the Qs to the S&P improved a little bit, as did the discretionary to the S&P. We're right on the moving average with large cap growth versus large cap value. Here's our growth value ratios, showing a little bit of improvement with the large caps, mid caps, and even the small caps. The 50-period exponential moving average of the new highs minus the lows remains above 0, and the indicator is still above 0 as well. That's positive. The 2-year Treasury yield, which had spiked up, is coming back down. That already gave some support to stocks. If interest rates continue to fall, will that give more support to the S&P 500? And our staples, we're still wondering if this is a valid spike. We did see a decline in the overall ratio. What's our outlook for Monday? Earnings season is now beginning, and that could be very influential on each day's session. The technicals are positive and working off being overbought. We have the Empire State Manufacturing Survey coming out on Monday, the NAHB Housing Market Index, and the geopolitical events, barring anything on this list that could come flying in at any time. The markets are still fixated on inflation and interest rates while keeping a close eye on the banking situation. We have a number of speeches coming up this week. On Tuesday, Governor Bowman will be speaking. Then on Thursday, Governor Waller will be speaking. There'll also be another speech on Thursday by Governor Bowman. And then on Friday, there'll be a speech by Lisa Cook. Sometimes these can be somewhat influential. That speech that came out before the market opened on Friday was by Governor Waller. And sometimes when he talks, the market really reacts to that, especially when it's negative. Looking at the Stock Trader Almanac statistics for Monday, tend to be pretty positive with the Dow being up 71.4% of the time. The S&P is more neutral to positive, being up 61.9% of the time, where the NASDAQ is tilted more negative, being up 47.6% of the time. Then April tends to be positive overall. Then this chart is the yearly statistics, which is adding more to our positive backdrop. Here's the chart showing the green line that we should be going up. So we have positive seasonality. Also with the gray line, positive seasonality, and this other gray line is also showing things looking more positive. We're on the 11th trading day of the month, and we are looking more positive with the green dashed line. So our scenarios, hard to go with the down one right now because everything is still pointing up. Technicals are positive and they're working off being overbought, so that may produce a little bit more weakness. But as we watch things, if it shifts, then we'll switch more to a negative stance, but it's not happening yet. Hard to go with the up one because the green line on the ADX is declining, but we still have a positive environment overall. However, because of the ADX, we're still favoring the sideways trend. The ADX is strengthening, meaning that it's above its moving average, but it's still below 20. It's positive, but the green line is declining. Some warning signs to be aware of. Volume remains below average. The S&P is working off being overbought. The VIX is showing a lot of complacency and really dropped on a down day in Friday's session. The S&P is underperforming utilities. The S&P new highs and new lows are lagging and starting to roll over with that 5-period moving average. We're still in a risk-off posture right now. That's more negative for stocks and positive for bonds. Small caps are underperforming in a good, solid environment. We want to see the small caps doing well. The Nasdaq may be declining from that double top that we've been watching. The home builders' negative divergence is still there, but as we're going further out, it's becoming a lot less relevant. I'll probably take it off of this list after Monday's session. And earnings season is beginning. Our conclusion, the S&P is positive, but working off being overbought. Same thing in the short and intermediate term. Where long term, we're still positive as long as we stay above the 200-day simple moving average, and we still had that recent golden cross. Thank you. I hope all of you have a really nice weekend. I will look to prepare the weekly video, the intermarket analysis video, and the deep dive video and get those posted just as soon as possible. So have a great day, and I will talk to you in the next video.